Hello, everyone. Welcome back to the Trading Room. I'm Shane Vernier, and this is FOMC Live. Today, we're going to be breaking down Jay Powell's latest press conference. We're going to get the verdict on what the Fed did. Spoiler alert, they cut by 25 basis points, just like the markets expected. We're going to talk about maybe where we go from here. We've got a lot, really just a tremendous amount going on that I'm looking at very closely, and I'm saying, okay, stocks were up, and then we sort of retraced, and now we're sort of near flat, but now we're rallying. Really, I mean, these markets have no direction. Right now, it's all about trade deals. It's all about Trump and Xi tomorrow or the next day. It's all about the U.S. government shutdown. And right now, believe it or not, this monetary policy move, as much as everybody builds these things up in their mind, it isn't the market driver that most of us think that it should be. I see we're going into a major rate cut cycle. That's a key thing. That's a big time thing, because that suggests not just that there's going to be more money in the U.S. system to sort of foster that economic growth that pretty much everybody talks about every day, but there's going to be a major shift in the way the central bankers in this country have thought. Remember, we're getting ready to ditch a lot of FOMC members. Jay Powell's history, you're going to have a couple of members on that FOMC that are going to be turned over. You're going to see a very, very dovish policy mindset moving forward. This is the beginning of that. So what I want to see is I want to see Jay's demeanor in the presser. I want to see him answer the questions about the government shutdown. And then also we're going to read a little bit from the prepared statement. Honestly, there's not much there. There's not much meat on the bone, but we're going to do it anyways because it's good exercise. And then, of course, we've got a ton of levels. We've got trade ideas, and I'm willing to ask any question that you may have. Today's a little tough to answer questions, though, because when Jay takes the stage, usually we like to listen to what he has to say. But it's good to see everybody back in the room. Big crowd over there on YouTube. Good to see everybody out there. Innocent, SSGK, it's a boy. Let's see, Ahmed. Good to see you, Ahmed. Welcome. Steve Francis, always a pleasure. Steve, Andrea Garwal over in our How to Trade community. I'm confident everything's going well, Andrea. I'm sure you made some great trades today. Today's always a tough day to trade. Tuku, good to see you, Tuku. T. Marina, afternoon. One of my rules is I don't trade Fed days. I don't do it. I've taken some of my biggest losses trading the morning of a Fed day. I watch markets trend. I watch a lot of things happen that shouldn't happen on a given day, and they typically do. So most of the time, I lay off of Fed day trading, but tomorrow is always the best day. I mean, the day after the Fed, going into tomorrow's session where we've got the ECB getting involved, we've got the Bank of Japan. We've got a lot going on in the central banking industry here. It's good stuff, guys. It's absolutely good stuff. The next 24 hours is going to be far better than the previous 5. I guarantee you that. So if you guys get into it, this is going to be a good time to trade. We're going to do some short-term trading here on the 920 crossover. We're also going to point out what's going on with one of our trade ideas that's sort of getting pummeled right now, but making a bit of a comeback. Still confident we're going to get paid off, but we got to wait and see how that Great Britain pound Aussie turns out. Let me see, Innocent. We're South Africa. We lit. TRC, we lit in South Africa. All right, fantastic. Jeanette, good to see you. Jeanette down under, getting up early or staying up very late. I'm not sure which. All right, guys, Andy Tong, good to see you. All right, guys, let's go ahead and dive into this. Let's get right out to price action here. This is a Great Britain pound Aussie. This is a trade idea that I've had out for a while now. Really like that long-term 62% level, and we've had really some amazing hits in gold off of these long-term Fibonacci levels. This one's not working very well at all. Great Britain pound Australian dollar. Really, we were looking to go long on the red line and catch a quick bounce. It was an almost, but a not quite. It was very, very close to paying us off. It just didn't quite happen. This is sort of what I like to do, scalp Fibonacci levels, Fibonacci numbers. And you see right here, we went right down to our entry, got entered, and then right there, we were almost there. And now price is falling away and sort of basing out. So I'm still confident that we're going to rotate higher in this trade. I really believe that today's action is sort of been predicated upon what's going on in gold. Gold, you're seeing up about 1%. Typically, that's a good thing for the Australian dollar. Sort of has it flatlining right now. So if you do see gold sell off, which is very, very possible, it's actually happened since we saw the FOMC speak, then we'll have a chance maybe to get back on the good foot in that trade. I think it's a pretty darn good one. The other trade idea that I wanted to cover real quick, US 100 counter trend shorts, 27.5. Remember, trending markets, all we really have to go on is big round numbers. So in the US 100, the Nasdaq 100, it's been all about 25,000. Now the next one up is 2750. Remember, quarter handles are very important. Even numbers, 25, 25 and a quarter, 25.50, things like that. That's absolutely huge. 25,000, 27.50 is a big one, and we're getting there. So we've got a counter trend short trade idea up there from just underneath 27.5. I think we could get there relatively soon. Right now we're trading about 26. It's just another 1,500 points or so. I think we could get that. Maybe if you see a tariff agreement or a peace agreement in the trade war between Trump Xi later this week and some positive sentiment come out of that meeting, we could go to 27.5 early next week. I see it before Thanksgiving, but I definitely want the counter trend short, and I wanted to get it out there just in case we had a major breakthrough and a rally in big tech. So definitely a lot going on there. We want to get on out to some of our forex pairs. We don't have much time here. We've got about 6 minutes until J Powell gets involved. This is your MT5 platform. Let's see, Jeanette, early morning. Great to see you live again. Sure a pleasure to be here. Jeanette, thank you for joining me. Thank you for making the effort. If you have any questions at all, be sure to ask. Let me see. Razor Roses, the Fed cut rates by 25 points, 25 basis points. Didn't know the news was out already 21 minutes ago. What's the speech for if he already announced? Because the speech is where the devil's in the details, Razor. We already knew they were going to cut interest rates today. That didn't surprise anybody. What we want to know is what does Jay Powell have with regards to forward guidance? What is going to be the deal going forward? Are we going to have a chance to understand what's going to happen in December? Or is he going to say, I'm uncertain, we don't know, the government shutdown messed up all of our models? That's what I want to see. And those questions are going to be asked today, so I'm very excited. The devil is always in the details. Ignore where to watch the live meeting right here. You're going to have it on in about 5 minutes. We're going to go out, and we'll have Jay, every word he says. This right up here, though, we had sort of a 4-hour trading level that I loved in this Australian dollar, New Zealand dollar. You'll notice we're covering some of those minor pairs or maybe those cross pairs because I kind of want to get away from the U.S. dollar right now, but that's okay. We've got a nice level right there, right on 114. 114.08. You'll notice that this tail just developed on our Fed meeting. I still like this as being the primary wave in that area right around 114-ish. Pretty good level there if you are trading the Australian dollar, New Zealand dollar. Great Britain pound USD monthly chart. This is the level that I've been focused on for a long time. Very, very long time. Right there, what do you have? You've got 131.66-ish, somewhere right in there. That's a monthly Fibonacci zone. It's been just a beautiful monthly double bottom. That's a good one. That's a pretty good one. So I'm very confident that we could get a bullish bounce from that zone. That's a nice support level in the Great Britain pound USD that you probably want to be aware of. Euro USD weekly chart. I really like this wave. You'll notice I'm just using Fibonacci numbers for now. We're going to look at a few other approaches here in just a second. This top right here, this double bottom, the pullback, the 38% level is very, very strong, staunch resistance. I hate saying hope. Hope's not a good thing to have when we're in the markets. I take a lot of criticism for I'm being down on hope, saying, Shane, what do you mean? You don't like hope? I say I love hope. Hope's great. Hope will keep you going in the gym. Hope will keep you going getting out of bed every day. Hope will keep you going in relationships. But in the markets, if you find yourself hoping that your position comes back, you're dead as fried chicken. You're a dead duck. We don't hope in the markets. We are locked and loaded because we got the tools and the talent. That's what it's all about. Be confident. Have some swagger. Be cocky. Believe in your strategy, whatever it is. Believe in yourself. We don't hope. Hope shows a lack of control, and we're in control when we trade. If you're not in control when you trade, you're not going to make it. All right? Get in control. Get educated. Get up to speed. Know yourself. Have a great psychological IQ. Understand where you're weak and where you're strong. Capitalize on your strengths. Minimize your weaknesses, and you'll be around for a long time. Don't do those things, well, and then you'll be watching YouTube trying to find out what the guy flying the private jet's getting done. But this strategy right here is one that's been with me for 12 years, 13 years. I'm very confident in it. There is some nuance to it, but we talk about these things every day on live stream. 116, font's tiny, hang on. 116.89-ish, 117 is going to be an absolutely fantastic zone up there to potentially take a sell here on the Euro USD. I wanted that today, didn't get it. Absolutely didn't get it. So I'm sort of depressed about that, but we're going to be all right. We're going to be all right. There's a lot of trades yet to have happen, and on cue, our Great Britain pound Aussie starts rallying up. I think we're going to be just fine. They're just going to give that a little bit more time to breathe and let it simmer a little bit. Can you pull out the live meeting in your stream? Absolutely. We're going to go. Actually, let's get right over there right now. You'll see we've got this, and I'll go ahead and turn the sound on. We'll do a quick sound check. Let's go ahead, unmute that, and then hit my desktop audio. I should get a thumbs up from you guys if, in fact, you can hear that. It's like some elevator music. I love the Fed and the way that they sort of the soft sell from the Fed. They're always giving us, but I love that too. Did you see that? Just went by the camera. They have construction equipment right in front of the the live feed of the National Mall. There, they have construction equipment because they're tearing down that side of the White House. It's absolutely crazy times, guys. Crazy times. Powell's going to speak here in just a second, so we definitely want to watch that. That's the desktop. We should be good to go. We'll turn that up as loud as we can. We should be good, ready to go right there. Okay, so let's get back onto price action here real quick. What we're going to be looking to do here during this engagement in about 1 minute is we're going to be looking to trade this. I love this this gold chart. We're going to be monitoring this with our 920 crossover, and we're going to look to make a few demo trades here for you to show you how this strategy works. I like lining these up in real time. They're a lot of fun, and if you want to, you can follow along if you'd like. But this is demo dollars for educational purposes only. This right here, though, we're watching a 5-minute chart. I really like a 5-minute duration here when it comes to the gold. Now, this is an interesting level. We're going to be watching the E-mini S&P 500 futures closely. We're also going to pull that on a 920 chart as well. And something like this, we opened gap up this week. I think we could get some bearish action here. Up and no further ado. Okay, here we go. We've got Jay Powell coming into play. Let's see what he's got. Should be interesting. We're watching everything about Jay here. Purple tie again.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Although some important federal government data have been delayed due to the shutdown, the public and private sector data that have remained available suggests that the outlook for employment and inflation has not changed much since our meeting in September. Conditions in the labor market appear to be gradually cooling, and inflation remains somewhat elevated. In support of our goals and in light of the balance of risks to employment and inflation, today the Federal Open Market Committee decided to lower our policy interest rate by a 1/4 percentage point. We also decided to conclude the reduction of our aggregate securities holdings as of December 1. I will have more to say about monetary policy after briefly reviewing economic developments. Available indicators suggest that economic activity has been expanding at a moderate pace. GDP rose at a 1.6% pace in the first half of the year, down from 2.4% last year. Data available prior to the shutdown show that growth in economic activity may be on a somewhat firmer trajectory than expected, primarily reflecting stronger consumer spending. Business investment in equipment and intangibles has continued to expand, while activity in the housing sector remains weak. The shutdown of the federal government will weigh on economic activity while it persists, but these effects should reverse after the shutdown ends. In the labor market, the unemployment rate remained relatively low through August. Job gains have slowed significantly since earlier in the year. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Although official employment data for September are delayed, available evidence suggests that both layoffs and hiring remain low, and that both households' perceptions of job availability and firms' perceptions of hiring difficulty continue to decline. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen in recent months. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index suggest that total PCE prices rose 2.8% over the 12 months ending in September, and that, excluding the volatile food and energy categories, core PCE prices rose 2.8% as well. These readings are higher than earlier in the year as inflation for goods has picked up. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market and survey-based measures.
Tariffs.
Beyond the next year or two or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a 1/4 percentage point to 3 3/4 to 4%. Higher tariffs are pushing up prices in some categories of goods, resulting in higher overall inflation. A reasonable base case is that the effects on inflation will be relatively short-lived, a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to ensure that a one-time increase in the price level does not become an ongoing inflation problem. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside.
Really?
A challenging situation.
Wow.
There is no risk-free path for policy as we navigate this tension between our employment and inflation goals. Our framework calls for us to take a balanced approach in promoting both sides of our dual mandate. With downside risks to employment having increased in recent months, the balance of risks has shifted. Accordingly, we judged it appropriate at this meeting to take another step toward a more neutral policy stance. With today's decision, we remain well positioned to respond in a timely way to potential economic developments. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the
Look how
evolving
fast
outlook,
that moved.
and the
Boom.
balance of risks.
Boom.
We continue to face
Look at that.
two-sided risks. In the committee's discussions at this meeting, there were strongly differing
Look at that
views
sweep
about
low.
how to proceed
Unreal.
in December. A further reduction in the policy rate at the
Look at
December
gold,
meeting
same thing.
is not a foregone conclusion. Far from it. Policy is not on a preset course. At today's meeting, the committee also decided to conclude the reduction of our aggregate securities holdings as of December 1. Our long-stated plan has been to stop balance sheet runoff when reserves are somewhat above the level we judge consistent with ample reserve conditions.
Huge move.
Signs have clearly emerged that we have reached that standard. In money markets, repo rates have moved up relative to our administered rates, and we have seen more notable pressures on selected dates, along with more use of our standing repo facility. In addition, the effective federal funds rate has begun to move up relative to the rate of interest on reserve balances. These developments are what we expected to see as the size of our balance sheet declined and warrant today's decision to cease runoff. Over the 3.5 years that we've been shrinking our balance sheet, our securities holdings have declined by $2.2 trillion. As a share of nominal GDP, our balance sheet has fallen from 35% to about 21%. In December, we'll enter the next phase of our normalization plans by holding the size of our balance sheet steady for a time, while reserve balances continue to move gradually lower as other non-reserve liabilities, such as currency, keep growing. We will continue to allow agency securities to run off our balance sheet and will reinvest the proceeds from those securities in Treasury bills, furthering progress toward a portfolio consisting primarily of Treasury securities. This reinvestment strategy will also help move the weighted average maturity of our portfolio closer to that of the outstanding stock of Treasury securities, thus furthering the normalization of the composition of our balance sheet. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices.
Second time
We
he
remain
said
committed to supporting our maximum employment, bringing our inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Very, very questionable. Very questionable. The part about inflation being a huge topside risk, that suggests that maybe the rate cuts won't keep coming.
With how market
That's huge.
pricing has assumed a rate cut as a foregone conclusion at your next meeting?
Well, as I just mentioned, a further reduction in the policy rate at the December meeting is not a foregone conclusion, as I've just said. So
that's what shook the
I would say
markets.
that needs to be taken on board. We had, just say this, 19 participants on the committee. Everyone works very hard at this and takes their obligations to serve the American people very seriously. And at a time when we have tension between our two goals, we have, strong views across the committee. And as I mentioned, there were strongly
Look at
different
that.
views today. And the takeaway from that is that we haven't made a decision about December, And, we're going to be looking at the data that we have, how that affects the outlook and the balance of risks, and I'll just say that.
You and some of your colleagues have framed last month and maybe today, I won't put words in your mouth, there's a risk management exercise. At what point do you conclude that you've taken out enough insurance? Are you looking for some kind of improvement in the outlook, or could this
doesn't
unfold
know.
along the lines of last year, where you made a sequence of
He doesn't
adjustments
know.
and then waited to gather more information?
So the way I've been thinking about it is the risks to the two goals. For a very long time, the risk was clearly of higher inflation. And then that has changed now. And as we saw particularly after the July meeting, we saw the downward revisions in job creation, we saw a very different picture of the labor market and suggested that there were higher downside risks to the labor market than we had thought. And that suggested that policy, which we had been holding at a I would say modestly, others people would say moderately restricted
You got a ways
level,
to go before
needed
US
to move
100s
more
to buy
in the
Demon
direction
or Desmond.
over time of neutral. If the two goals are sort of equally at risk, then you ought to be at neutral, because one of them's calling for you to hike and one of them's calling for you to cut. So if that got back into balance, then you'd want to be roughly at neutral.
I wouldn't
So
mind
in that
buying
sense,
gold.
It was a risk management. And I would say the same about today, sort of the same logic. But as I mentioned, going forward is a different thing.
Claire. Claire Jones, Financial Times. Thank you for taking this question.
Come on, make it good.
We've just heard from you that the discussion in December and the conclusion of the discussion is not a foregone conclusion. I'd like to just dig into that a little bit more about what sort of arguments were brought up. Was there any consideration, for instance,
He's gonna crater the markets.
investment we're
If he
seeing in
says it's
AI
we're
and
not
some
gonna
of
cut,
the
he's gonna crater them.
household wealth through rises in stock prices related to the AI boom?
Choose your words carefully, Jay.
I wouldn't say that's a factor in everyone's assessment of the economy. I wouldn't say it's the driving factor. I don't think for anybody. I guess I would say it this way. Once again, I would just point out that we have the situation where the risks are to the upside for inflation and to the downside for employment. We have one tool. It can't do both of those. You can't address both of those at once. You've got a very different situation. So you have some people have different forecasts, right? So they'll forecast faster or slower progress on one or the other, and they also have different levels of risk aversion. And
He's struggling.
Some will be more averse to inflation overruns, and some will be more averse to underruns of employment. And so you put that together, and as you can see from the SEP and from the public discussion that goes on between the meetings when participants go out and talk, they're very disparate views, and they were reflected in strongly differing views in today's meeting, as I pointed out in my remarks. And that's what leads me to say that, that we haven't made a decision about December. I always say that it's a fact that we don't make decisions in advance. But I'm saying something in addition here, is that it's not to be seen as a foregone conclusion. In fact, far from it.
Look at that.
Can I just ask a quick follow-up
Boom.
on QT? How much of the
only 10
fund
grand.
impressions we've seen in money markets are related to the U.S. Treasury issuing more short-term debt?
That could be one of the factors, but the reality is we've seen, the things that we've seen, higher repo rates and federal funds rate moving up. These are the very things that we look for. We actually have a framework for looking at, what the place we're trying to reach. Well, what we said for a long time now is that when we feel like we're a bit above what we consider a level that's ample, that we would freeze the size of the balance sheet. Of course, reserves will continue to decline from that point forward as non-reserve liabilities grow. So this happened, some things have been happening for some time now, showing a gradual tightening in money market conditions. Really in the last, call it 3 weeks or so, you've seen more significant tightening, and I think a clear assessment that we're at that place. The other thing is, the balance sheet is shrinking at a very, very slow pace now. We've reduced it by half twice, and so there's not a lot of benefit to be holding on to get the last few dollars, because again, the balance sheets, the reserves are going to continue to shrink as non-reserves grow. So there was support on the committee as we thought about it to go ahead with this and announce effective December 1 that we will be, freezing the size of the balance sheet. And the December 1 date gives the markets a little bit of time to adapt.
Unbelievable. They're going hawkish. The CME Fed Watch Index has been taken off the board.
So much of the rationale
I'm
for
watching
cutting
it right
interest
now.
rates,
It's off
even
the
as
board.
inflation moves away from the 2% target seems to be, that there are these mounting downside risks to the labor market. But if those don't materialize and the labor market either stabilizes around current employment levels or even starts to strengthen somewhat, how would that change your perception of how much interest rates need to fall from here? Would you then be a bit more concerned about underlying inflation and the possibility of second round effects from tariffs?
Yeah, I mean, in principle, if you were to see data that suggested that the labor market's strengthening or even that it's stabilizing, that would certainly play into our decisions going forward. So, and we do have, we get some data. The labor market is a place where we get, for example, we get the state level data on initial claims, which are sending a sort of a signal of more of the same. We also get job openings, and we'll get lots of survey data. We'll get the Beige Book and things like that.
Yeah.
So we'll have a picture of
You're
what's
getting the
going on in
NFP
labor
numbers
market.
too.
And the fact that
We aren't,
we're
you
not
are.
seeing an uptick in claims or a downtick really in openings suggests that you're seeing maybe continued very gradual cooling, but nothing more than that. So that does give you some comfort.
Potential buy here on this
But if
Bitcoin
this shutdown
920
lasts a while longer
crossover.
and you don't have that data in hand, I'm just wondering how that hinders the committee's ability to assess the state of the labor market and make the right policy decisions, and also how much is that factoring into the debate about December?
Yeah. So we get like I mentioned what we get in the labor area. We get some data in inflation, some data in economic activity. And we'll have a picture of what's going on. We also will have the Beige Book again. I would say we're not going to be able to have the detailed feel of things. But I think if there were a significant or material change in the economy one way or another, I think we'd pick that up.
No, he didn't answer the
In terms
question.
of how it might affect December, it's really hard to say. December's the meeting's like 6 weeks away. We just don't know what we're going to get. If there is a very high level of uncertainty, then that could be an argument in favor of caution about moving. But we'll have to see how it unfolds.
Steve.
This is unbelievable. It really is.
CNBC.
He said we don't get the data, but we get
Chairman,
some
can you
data.
characterize the
What?
meeting in terms of, you said strongly differing views. Was this a close call, this cut, or was it a close call maybe the other way?
Great
Because you had
question, Steve.
the sense on both sides. Thanks.
So I was referring to the discussion about, to the extent it related to December. You saw we had 2 dissents, one for 50 and one for no cut. So that was a strong, solid vote in favor of this cut. The strongly differing views were really about the future. What does that look like? And I think people are saying, they're noticing stronger economic activity. Forecasters generally, broadly, have raised their economic growth forecasts for this year and next year, in some cases quite materially. In the meantime, we see, a labor market that's kind of, I don't want to say stable, but it's not clearly in motion. It's not clearly declining quickly in any case. It may be just continuing to gradually cool. And again, people have different forecasts and expectations about the economy and different risk tolerances. And so there's you read the SEP, you read the speeches, there are differing views on the committee, and to the point where I said what I said.
And just to follow up on the balance sheet, if you stop at the runoff now, does that mean you have to go back to actually adding assets sometime next year so that the balance sheet doesn't shrink as a percentage of GDP?
He goes, that's the
become a
next
tightening
guy's
factor?
problem. That's
So
the next
you're right,
chairman's problem. It's not
The place
mine.
will be on December 1 is that the size of the balance sheet is frozen. And as mortgage-backed securities mature, we'll reinvest those in treasury bills.
Okay.
Which will foster both a more treasury balance sheet and also a shorter duration. So that's what, in the meantime, if you freeze the size of
would
the
you do
balance
that?
sheet, the non-reserve liabilities, currency, for example, they're going to continue to grow organically. And because the size of the balance sheet is frozen, you have further shrinkage in reserves. And reserves is the thing that we're managing that has to be ample. So that'll happen for a time, but not a tremendously long time. We don't know exactly how long. But at a certain point, you'll want to start reserves to start gradually growing to keep up with the size of the banking system and the size of the economy. So we'll be adding reserves at a certain point, and that's the last point. Even then, we didn't make decisions about this today, but we did talk today about the composition of the balance sheet, and there's a desire that the balance sheet be right now it's got a lot more duration than the outstanding universe of Treasury securities, and we want to move to a place where we're closer to that duration. That'll take some time. We haven't made a decision about the ultimate endpoint, but we all agree that we want to move more in the direction of a balance sheet that more closely reflects the outstanding treasuries, and that means a shorter duration balance sheet. Now, this is something that's going to take a long time and move very, very gradually. I don't think you'll notice it in market conditions, but that's the direction of things.
I've been covering this for a long time. That right there was a ridiculous answer that didn't even address the question, and he talked about something nobody understands.
Interpreting the latest CPI
He's just killing time up there.
So
Said
some
nothing.
components came in lower than expected, but core inflation was still at 3%. So at this moment, what are you learning about the drivers, and also do you view that
Might
the
grab a
risks are greater
Bitcoin
that
buy
the Fed
right here
makes
if we
a
get this
mistake on
crossover.
employment or inflation?
It's not a bad play, right above
So
110.
the September CPI report, we didn't get PPI after that, which is important for translation into what we look at.
We didn't
which
have
is
enough
PCE
information.
inflation, but we can still make a pretty good assessment of what that will be. When we get PPI,
this
there
guy's
might be
priceless.
some adjustments. But so directionally, it was a little softer than expected, and we always break it down into the three components. So basically, you've seen goods prices increasing, and that's really due to tariffs. And that's compared to a longer run trend of very, very mild deflation in goods. So that's moving inflation up. On the other side of that, good news that housing services inflation has been coming down and is expected to continue to come down. So if you remember a couple of years ago, that's the one that we kept expecting it to do that. Now it's been doing that for some time, and we expect to continue that. That leaves the biggest category is services other than housing services. And that's kind of been moving sideways over the last few months, but a significant part of that is non-market services, and we don't take a lot of signal about the tightness of the economy from that. So if you add all that up,
This is
a
interesting.
couple things to say. One is that inflation away from tariffs is actually not so far from our 2% goal. We estimate, people have different estimates of what that is, but it might be 5 or 6 tenths, and so that if it's 2.8, then core PCE not including tariffs might be 2.3 or 2.4 in that range, something like that. So that's not so far from your goal.
Market's rebounding.
So that we look at that, and the thing about tariff inflation is the base case is that it will come, and it probably will increase further. But it is that it will be a one-time increase, and we've been very focused for
That's
all of
called
this
entrenched
year
inflation,
at making
Jerome.
sure that
Come
that's
on.
the case, and thinking carefully about
You know that.
what are the pathways through which it could become something else, troublesome inflation. One of those would be, a really tight labor market. We don't see that. Another could be inflation expectations moving. We don't see that. So I think we're watching this very carefully. I think it's not the case that we're just assuming that it's going to be a one-time inflation. We understand fully this is a risk we have to monitor and ultimately manage.
With the stubborn in services inflation, what are some of the things that the Fed could do to address that, especially when we're seeing potentially labor supply challenges?
Sorry, say that.
Word
The
salad.
stubborn services inflation that you mentioned.
Service inflation. Yeah.
That's a good question.
Again, the part of services inflation that isn't coming down as we would like it to is the non-market part of non-housing services. And overall that's just something that we expect will come down. The non-market part of it should come down. It largely reflects higher stock prices and financial services that are imputed rather than actually paid is a big part of that. But also just we think policy is still modestly restrictive in my telling. So that's the kind of thing that should lead to a gradually cooling economy. That's one of the reasons you see a gradually cooling labor market, is because Fed policy is modestly restrictive. So that should also help get that. I want to say, though, we're absolutely committed to returning inflation to 2%.
I won't let you demo
If you look
Bitcoin?
at longer-term surveys or market pricing, you will see that's a credible commitment.
In the case,
And
there's your
There
trade.
should be no question that that's where we're going.
Entry. Decent target right there, but you're going to
Great,
want to
thank
be
you.
somewhere up
Christopher
there.
Gabriel, Associated Press. So there's a big investment boom in AI infrastructure right now, as you know, and wondering if the existence of such a boom would indicate that rates are not that restrictive after all, and could further rate cuts at this point perhaps fuel an excess level of investment there or market bubbles. How is the Fed thinking about that?
So I don't think that you're right. There are a lot of data centers being built and other investments being made around the country and around the world.
That's a play.
And big U.S. companies are just investing a lot of resources in thinking about how AI, which will be based on those data centers, run through those data centers, is going to affect their businesses. So it's a big deal. I don't think that the spending that happens to build data centers all over the country is especially interest sensitive. It's based on longer run. It's longer run
comes the
assessments
gold.
that this is an area where there's going to be a lot of investment and that's going to drive higher productivity and that sorts of things. I don't know how those investments will work out, but I don't think they're particularly interest sensitive compared to some of the other sectors.
And then just a quick follow-up. You mentioned that you do have data that you're looking at for inflation and growth in the absence of government data. Could you give us a sense? I think we know a lot about the jobs data that's out there. Can you give us a sense of what you're looking at to track inflation in the absence of government data?
Good question.
So it's a lot of things, and it doesn't replace government data, but you know all of these. I'll just mention some of the many names: Price Stats, Adobe, and others. And for wage inflation, there's ADP data. On spending, you're going to ask about spending at some point. There are lots of other things that we look at, but it's many different sources, and again, including what we get out of the Beige Book, which will be sort of come out mid-cycle as always. And it doesn't replace the government data, but it gives us a picture.
What?
Again, I think if something material were happening, if there were material developments, I think we would pick that up. I don't think we'll be able to have the very granular understanding of the economy while this data is not available.
We knew it. He's going to blame the shutdown and tariffs. So it's the government's fault. It's the Fed's fault. It's not our
Howard
fault.
Schneider with Reuters. Thank you. I just wanted you to elaborate a little bit on what you said a moment ago about the lack, a continued shutdown, making it more difficult to make a move in December, and that may make you more cautious. To the degree you are relying on private data that isn't the gold standard, or that you're relying on your own surveys of the Beige Book, do you worry at some point you're going to have to start making policy by anecdote?
This is a temporary state of affairs, and we're going to do our jobs. We're going to collect every scrap of data we can find, evaluate it, and think carefully about
Right.
it. And that's our jobs. That's what we're going to do. If you ask me, could it affect the December meeting? I'm not saying it's going to, but yeah, you could imagine that what do you do if you're driving in the fog? You slow down. So that could or could not. I don't know how that's going to play into things. We may get the data may come back, but there's a possibility that it would make sense.
You
to be
could
more
go stop
cautious
loss
about
down
moving. I'm
there.
not-
You put your
yeah, I'm
stop
not
right
committing to
there.
that. I'm just saying it's
I would
certainly a
want to be
possibility
underneath
that you would say,
50.
we really can't see, so let's slow down.
As a
Unbelievable.
follow-up to the debate on this meeting, we saw recently
Shoot for a
some
modest
pretty big layoff
1-to-1,
announcements
something like
coming
that.
from Amazon and others. Wondering if that
Very,
figured into the
very
discussion at all,
questionable.
that you're starting to see this tension between growth and employment starting to be resolved, to the detriment of employment. And secondly, some of the stress is starting to appear in the bottom spur of the K, as they call it, household health premiums that are going to possibly be going up quite
Oversold
substantially,
right
things
there.
like that. Has that started to become a factor in
It's
your
an
policy
interesting
discussions?
trade.
So those are both things that we're watching very, very, very carefully.
It's going to be tough to get any
start
follow
with,
through today
the
with
layoffs.
this
You're right.
guy
You see
talking.
a significant number of companies either announcing that they are not going to be doing much hiring or actually doing layoffs, and much of the time they're talking about AI and what it can do. So we're watching that very carefully, and yes, it could absolutely have implications for job creation. We don't really see it in the initial claims data yet. Now, it's not a surprise that we don't. It takes some time for it to get in there, but we're watching that really carefully. But again, don't see it yet in the initial claims data. On the K-shaped economy thing, I would say the same thing or similar thing. We are
Bitcoin coming back down.
If you listen to the earnings
choppy,
calls or
ugly
reports of big public consumer-facing companies, many of them are saying that there's a bifurcated economy there, and that consumers at the lower end are struggling and buying less and shifting to lower-cost products, but that at the top, people are spending at the higher income and wealth, and so much anecdotal data on that, and so we think there's something there.
Edward.
Thank you, Edward Lawrence with Fox Business. So, Mr. Chairman, I want to take another crack at the further reduction in rates is not a foregone conclusion. So in December, he said, far from it. So if a cut might not be on the table for December because of lack of data, what is the other concerns?
Because of lack of data.
So if it's not lack of data
Wow.
as the reason December is not a foregone conclusion, what other things could be the concern then?
Well, the perspectives of people on the committee that, we've now moved 150 basis points, and that we're down into you're into that range between 3 and 4, where most estimates.
There's your high right on the release today. Right there's the release.
Live in that 3 to 4% area. You're there now. You're
buying
above
back the losses.
The median number.
Chop City.
But I think there are people on the committee who have higher estimates of the neutral rate, and that's you can argue these positions since it can't be directly observed, the neutral rate. So, I think for some part of the committee, it's time to maybe take a step back and see whether there really are downside risks to the labor market, or see whether in fact the growth, that the stronger growth that we're seeing is real.
Just whipsaw.
Ordinarily, the labor market is a better indicator of the momentum of the economy than the spending data. That's the lore. In this case, that gives a more downbeat read. So people just have, again, we've cut 50 more basis points in the last 2 meetings, and there was a sense like, from some, let's pause here, kind of thing, and a sense from others wanting to go ahead. But that's why I say differing views, strongly differing views.
I mean, you can see what's happening here.
You're talking about,
the word
going
pause,
forward. So what's
the
more
word
important
wait.
in
That means
this
no more
division? Is
rate
it
cuts this
inflation
year. It
risks? Is
crashes the markets
employment risks?
every time he
Or
says
is there
it.
a deeper philosophy division among
Said
the
it
board?
right here.
Look, everybody
Saying it
on the
right here
committee
now.
is deeply committed.
Trading this
to
stuff
doing
is
the right
very
thing
difficult.
to achieve
Very
our goals,
difficult.
maximum employment and stable prices. You have differences on how to do that, and as I mentioned, some of that is different forecasts, but a lot of it is also different risk aversions to the different different variables, which is common through all Federal Reserves. People just have different risk tolerances, let's say. So that leads you to people with disparate views. You will know that from the speeches you've been listening to from my colleagues, and so we're at a place now where we have in fact cut 2 more times, and we're 150 basis points closer to neutral, wherever that may be, than we were a year ago. And so there's a growing chorus now of feeling like maybe this is where we should at least wait a cycle.
Unbelievable.
Like that.
Unbelievable.
That's what it is. It's just what you think it would be.
You're setting up to crash the markets,
you've seen
Jay, and you know it.
In the September Summer of Economic Projections, you've seen this in the public remarks of FOMC participants, and now I'm telling you that's what you can expect that in the minutes, and I'm just telling you that's what happened in the meeting.
There's a 68 to 32 chance of one more rate cut this year. That's down from about 90. Big shift.
What is your explanation for why
Big
the
shift.
job market is weakening right now, and what will this rate cut do to improve the job market?
Nothing.
So I think there are two things affecting the job market, and one of them is just a dramatic reduction in the supply of new workers. So, and that's two things. That's declining labor force participation, which is a cyclical thing.
You
and
can put it
there's
beneath
declining
the swing
immigration,
low if you
which is
want.
just a big policy change that actually began in the last administration, and it has been accelerated.
Just don't think
now.
you're going to get it.
So a big part of the whole story is that supply side story. Okay. In
Could
addition,
reverse.
labor demand has declined, and
Might
you
be
know,
the way to do
so
it.
The unemployment rate has gone down, meaning that demand for workers is going down a little more than supply. So that's what's going on, but it is mostly a supply function. It's mostly a function of the change in supply, I think, and many people think. So the question then is, what does the our tool do, which supports demand, and and I would just say, when you're in a situation where job creation, if you adjust for likely overcounting in the way that BLS does its work, is pretty close to zero. So
Flat on
employment
Bitcoin.
doesn't, on a sustainable basis, doesn't, if you're creating zero jobs, if it's in equilibrium, if it's in balance, it's a pretty, as I said before, a pretty curious balance. So, I thought, and many of my colleagues thought, in fact, you've seen the last two meetings, that it was appropriate for us to react by supporting demand with our rates, and we've done that. We've reduced so that rates are looser. I wouldn't say that they're accommodative right now, but they're meaningfully less tight than they were, and that should help, so that at least the labor market doesn't get worse. Though it's a complicated situation, and some people argue that this is supply and we really can't affect it much with our tools, but others argue, as I do, that there is an effect from demand, and that we should use our tools to support the labor market when we see this happening.
You also talked about tariffs causing a one-time price increase. Should American household consumers expect that inflation will continue to go up this year because of those tariffs?
So the basic expectation is that there will be some additional increase in inflation, because it takes a while for tariffs to work their way through the production chain and finally get to consumers. And we see this now from the tariffs that were put in place now many months ago. We see those effects, but if you put tariffs in effect, and they've been coming into effect consistently in February, March, April, May, and that's all happening. So that'll continue to happen for some time, probably into the spring. These are not big increases, though. These are a tenth or so on inflation. They may be big increases on a particular product that's been tariffed, but overall, these are fairly modest. I think some projections go, we're at 2.8% inflation. You might get 2 or 3 more tenths or 4 more tenths maybe. But then, as all of the tariffs are in, they stop generating inflation. You've had a one-time price increase. As long as you're not, at least this is the theory. This is how we believe and hope that it will work out. Once the last tariff is put on something, at that point, it becomes a higher price level, but it stops going up.
It's called entrenched inflation.
At that level,
He doesn't
and then
want to say
measured
it.
inflation will come back down to non-tariff inflation. As I mentioned, non-tariff inflation is not so far from 2% now. Now, consumers are not interested in that story. Their prices are higher. More than that, the reason they're so unhappy about inflation is the inflation that we had in 2021, 2, and 3. Because you can say that prices aren't going up as much, but that doesn't mean people aren't feeling those higher prices from the inflation we had 2 or 3 years ago. They are, and that's, I think, a large part of why the public, if you sample people, inflation is still very much making people quite unhappy. Even, and it's nice that, that prices are not going up as fast as they were, but they're still much higher than they were. And it'll take some time for that effect to wear off. As real incomes rise, it will feel better over time, but that's going to take time.
Dollar yen.
Michael McKee from Bloomberg Television and Radio. Do you have any concerns that equity markets are or are close to being overvalued at this point?
He won't comment on the markets.
We don't look at any one asset price and say, hey, that's wrong. It's not our job to do that. We look at the overall financial system, and we ask whether it's stable, whether it could withstand shocks, right? So Banks are well capitalized, while some households are clearly under stress. In the aggregate, households are in good shape financially, relatively manageable levels of debt. At the lower income spectrum, you are seeing rising defaults, particularly around subprime auto, but nonetheless, in the aggregate, pretty good. You don't see too much leverage in the banking system or the financial system. It's a mixed picture, but it's not an overly troubling picture. And again, I'm not. It's not appropriate. We don't set asset prices. Markets do that.
Well, you must be well aware that by lowering interest rates, you're contributing to additional asset price increases.
Sure.
And I wonder how you balance the idea that lowering rates would help the labor market with the reality that it seems more likely to be stimulating increased investment in AI, which is the rationale for thousands of job cuts that have been announced in the last few weeks.
Yeah,
Great question.
I don't think interest rates are an important part of the AI, of the data center story.
Come on.
I think, people think they're great economics in building these data centers, and they're making a lot of money building them, and they think they have very high present value and all that sort of thing. It's not really about. It's not about 25 basis points here or there.
Yeah, it is. They
we
need
use some
billions of
tools to
dollars to
support the
build
labor
these
market
things. You have
and
to get the money cheap.
create,
That's business
price
101,
stability.
Jay.
That's what we do.
This guy's
That's our two
finished.
jobs, right? So we're here to, by lowering rates at the margin, that will support demand, and that will support more hiring. And that's why we do it. Now, no 25 basis point or even 50 basis point hike is going to be a dispositive thing, but ultimately, lower rates will support more demand, and that'll support hiring over time. And of course, we also have to be careful about this, which is what we've been doing, because we know where inflation is, and we know that, I've told you the story. It's a complicated story, but this is the best assessment that we can make. Because there's uncertainty around inflation and the path ahead for inflation, that's why the pace we're going has been a careful one.
Victoria. Hi, Victoria Guida from Politico. On AI, I'm just wondering, it seems like a lot of the economic growth that we've been seeing is fed by investments in AI. So how worried are you about what a sudden contraction in tech investment would mean for the overall economy? Is there enough strength in other sectors? And specifically, are there any lessons that you take from the 1990s in how you might approach what's happening right now?
Yeah, this is different in the sense that the companies that are so highly valued actually have earnings and stuff like that. So if you go back to the 90s and the dot-com, these were ideas rather than companies, and so there's a clear bubble there. Whereas I won't go into particular names, but they actually have earnings, and it looks like they have business models and profits and that kind of thing. So it's really a different thing. The investment we're getting in equipment and all those things that go into creating data centers and feeding the AI, it's clearly one of the big sources of growth in the economy. Consumer spending also, though, has been, is much bigger than that, and has been growing and has defied a lot of, negative forecasts, continuing to do so this year. Consumers are still spending. Now, it may be mostly higher end consumers, or maybe skewed that way. But the consumer is spending, and that's a big chunk of what's going on in the economy, substantially bigger than
Pretty good level in play
AI.
right here
You
for the
point
pound.
to growth. I mean, actually,
We've been waiting on this one for a
growth
while.
as opposed to level, but
There it is.
Consumer spending is a much bigger part of the economy.
131.55-ish.
Why do you think that the labor market
It's a
is
big
slowing
zone.
so much, even though consumer spending is strong?
Why has it slowed so much?
Big zone.
Well, what's happened is that the supply of workers has dropped very, very sharply due to mainly immigration, but also lower labor force participation. So
Beautiful
and
25 pip
that
move
means
right there.
There's less need for new jobs because there isn't this flow.
This is one to watch, pound dollar.
Pool of labor that where people need jobs, because there aren't those people now. So there's not a supply of workers showing up for jobs. In addition, demand has also gone down, and so has labor force participation has declined, which is more of a sign, in this case, of demand as well as trend. So I think you're seeing some softening. The economy's growing at a slower rate than it was, 2.4% last year. We think around 1.6% this year. It could have been a couple of tenths higher if not for the shutdown. And of course that will reverse. But, you still got the economy growing at a moderate pace.
Andrew.
Hey there, Andrew Ackerman with the with the Washington Post. I wanted to ask if you could elaborate on how you think about policy in the context of the data drought. Does it make you inclined to stick with your plans as set out in September in the absence of the data that might change your mind, or does it make you inclined to proceed with added caution because of uncertainty?
Good question.
Yeah, well,
this
we'll
one crashes
when we
it.
face that question, if we face that question. It'll probably be argued both ways, right? But I've said a couple times here that, if you really aren't getting information you really don't know, and the economy looks like it's solid and stable and hasn't really changed, there will be an argument. I don't know how persuasive it will be, but there will be an argument that, you slow down when you can't see as far ahead.
That's the last time he said this.
Others
right
may
there.
argue,
He's saying it
I'm
again.
not sure where this argument will come, but you're perfectly
Third
right. You
time.
could also argue, well, things haven't really changed, but you might not know that. So I don't know whether we'll face this or not. I hope we don't. I hope by the time of the December meeting we're getting a better flow of data. But if we're going to have to do our jobs one way or the other.
Okay. I also just wanted to ask a FinReg question. I think several years ago you said the overall amount of capital in the system was about right. As the Fed moves forward with a revised Basel proposal, potentially changes to the GSIB surcharge, has that changed at all? Or are you planning to significantly reduce the amount of capital in the system? Thanks.
So there are discussions going on, I think, among the agencies, and I don't want to get ahead of those discussions. I continue to think that the level of capital, when I said that in 2020, was about right. And of course, there's been much capital added since then through various mechanisms. But I look forward to. I know those discussions are really just getting going. They haven't come to the point where they're got a whole plan and that kind of thing. So I really don't have much to say on that.
Brian.
Hi, Chairman Powell. Brian Chung with NBC News. Is the weakness in the jobs market accelerating, and who's at risk if the interest rate cuts are not the effective medicine for a further slowdown in the labor market?
So we do not see the weakness, as you put it, the weakness in the job market accelerating. I would say, then again, we didn't get the September employment report, payroll report, but we look at the unemployment insurance claims, initial claims are reported at the state level, and we still get those, and we can accumulate them and get the national number. And there's really, in no story, you can look at the numbers. Same thing with the job openings we get from Indeed. There's just no story over the last 4 weeks. It's kind of stable. So you don't see anything that says that the job market is, or really any part of the economy is making a significant deterioration. Don't see that. You see more things like I mentioned, though, which is you see big companies making announcements of either of layoffs or of the idea that they won't need to hire. Their number of employees is not expected to go up over a number of years. There may be different people working there. They say that too, but they don't need a bigger head count. So you see those kinds of things. You don't see it in the aggregate numbers. The layoff numbers have not gone up, but job creation is very low, and the job finding rate for people who are unemployed is very low. But the unemployment rate is very low as well. 4.3% is a low unemployment rate.
So as you make these cuts, is it the lower income workers that you're thinking about, or those who might have their jobs automated? Is there a particular section of the labor market that you're particularly?
So we can't, our tools don't allow us to target any demographic or any income level and that kind of thing. I do think that people, we saw this during the global financial crisis and the long recovery. If you have a long period of very strong labor market conditions, it benefits people at the lower end the most. The last 2 or 3 years of that long expansion, people at the lower part of the income spectrum were getting the biggest benefits, and lots of things were happening in that space demographically, which were very constructive. And we're not at that place right now. But so, yeah,
Pretty much,
a
Liam.
stronger labor market is the best thing we can do for the public. It's also part of our job. It is half of our job, but it is absolutely the best thing we can do for people. Along with keeping prices stable. Those two things. I mean, inflation also hurts people on fixed incomes more than other people.
Courtney.
They need to wrap this up.
Hi, Chair Powell. Courtney
making
Brown
no
from
sense.
Axios. As you know, the 12 Reserve Bank presidents' terms are up for renewal at the end of February. I'm wondering if you can give us a timeline for when the board will consider those reappointments and whether we can expect everyone to be re-upped or if we can expect some changes.
So it's a process that we go through under the law. The way the law works is we have a reappointment process every 5 years for all of the reserve, each of them and all of them. We're in the middle of that process, and we're going to complete it in a timely way. And that's really all I can say.
Okay, thank you.
Daniel.
Wow, they're still going.
Daniel Davis, Agence France Presse. You've now had dissents in 3 consecutive FOMC meetings, but in this meeting you had dissents going in both directions, and you've just mentioned there's strong disagreement over the future path of rate cuts. Have these disagreements complicated your role presiding over the FOMC meetings, and if so, how?
I wouldn't say that. No, I think you have to take what comes, and what comes right now is a pretty challenging situation where we have, first of all, we have 4.3% unemployment. We have an economy that's growing close to 2%. So, overall, it's a good picture. It's a good picture. But in terms of our policy, we have upside risks to inflation, downside risks to employment, and this is a very difficult thing for a central bank because, one of those calls for rates to be lower, one calls for rates to be higher. We can't do both, so we have to balance the two. And so it's a challenging thing, and as we have worked our way through this process, you would expect that there would be a range of views across the committee on what to do and the speed with which we should do it. And that's what we have. That makes a lot of sense to me. All of these people are, people who take their jobs very seriously, work very hard at this, and just want to do what's right for the American people, but they have different views on what that is. And, it's an honor to work among people who care that much. It is, but I don't feel that it's unfair or anything like that. It's a time when we're making quite difficult judgments in real time, and I believe we'll get through this, and I think we've done sort of the right thing so far this year. I think it was appropriate for us to be careful about this. I think it would not be appropriate to just ignore or assume away the inflation issue. At the same time, I think the risk of higher, more persistent inflation has declined significantly since April. And if we do wind up resuming rate cuts at some point, we will at some point. I think we're trying to get to the end of
I
the
like
cycle
the gold trade, but
with
he's
the
got to
labor
stop
market in a good
talking.
place, and with inflation, on its way to 2%.
I mean, he's been a
we're at
downer
2%.
today.
So that's all we're trying to do, and we're doing it under quite challenging circumstances.
Yeah, Kit,
and
we've been
doing
long
the best
gold
we
for a
can.
while now.
We'll go to Jennifer for the last question.
Fantastic.
Thank you so much, Chair Powell. Jennifer Schonberger with Yahoo Finance. Both regional and large banks have taken losses on loans given delinquencies on subprime auto loans. JP Morgan CEO Jamie Dimon warned, when you see one cockroach, there may be more likely. I'm curious how the Fed is looking at these loan losses and if it poses risks to the financial system or the outlook for the economy. Is it a warning sign?
So, we're obviously we watch these things very carefully, credit conditions very carefully. You're right. You've seen rising defaults in subprime credit.
Yeah, I
for
think
some
you're right,
time now,
Lander.
And now you've seen a number of subprime credit, automobile credit institutions having significant losses, and some of those losses are now showing up on the books of banks. We're looking at it carefully. We're paying close attention. I don't see at this point a broader credit issue. It doesn't seem to be something that has very broad application across financial institutions. But we're going to be monitoring this quite carefully and making sure that is the case.
And then separately, many, you yourself have said that we're in a bifurcated economy right now with high net worth individuals continuing to spend with the lower income pulling back. How much of consumer spending continuing hinges on the stock market remaining strong? In some odd way, does the market help keep the economy buoyant?
So there's some relationship there, but remember, the more wealth someone has, the lower an additional dollar of wealth matters. So your marginal propensity to consume declines quite dramatically.
Look at the last couple of questions, the impact they've had.
Market wealth. So, the stock market, it would affect spending if
Trade
the
of
stock
work,
market
probably,
went down, but it wouldn't drop.
but he's gotta
it wouldn't
stop
drop sharply
talking.
unless there were quite a sharp drop in the, in the
Negative.
stock market. People at the lower end of income and wealth have a much higher marginal propensity to consume of an incremental dollar of income or wealth, but they don't have the stock market wealth. So I think it's certainly a factor supporting consumption right now. But and you would see it if you saw a material correction in spending, but it wouldn't be. You shouldn't think that it'll dollar for dollar stop consumption, because that wouldn't be the case. Thanks very much.
All right, that was beyond brutal. I mean, we could talk a lot about, what Powell said. I can give you a few of my opinions. You can see the trading is just a mess. That's why this is high-risk stuff when you're trading in and around an economic event that has the gravity of a Fed announcements. The volatility comes and then it goes. What I have outlined here is there was a couple of statements that he made. Let's just go ahead and get rid of these drawings. But the statements about we may have to just wait and see in December, he said it there and he said it there. They tried to get him saying it again sort of right in here, but it fizzled. I think that, I really wasn't kidding. If you're trading this, like let's say you're in that long position to the gold market, you really are wanting him to shut his mouth. Because the longer that thing went, that was like a title fight. They took about 4 extra questions. That thing went almost an hour. They took about 4 extra questions. And as we got into the championship rounds, the chances of a knockout became more and more and more because the markets were watching for signs of fatigue out of Jay Powell. And it was said in the live chat here on the YouTube live chat, I was like, hey, this guy's tired and he's not making any sense. I thought today was, I won't say the word disgrace and I won't say that, but what we saw today was a complete word salad. It was said in the live chat over and over again. It was a word salad. What we saw was somebody that tried to explain the balance sheet in complete banker speak about short-term liabilities and long-term liabilities and the difference between the two and how they can hedge risk using a balance of short-term and long-term holdings. And then we're going to reinvest. We're going to sell off some of that and reinvest it back into treasuries. Well, if you're cutting interest rates, theoretically the yields on treasuries are going to go down. So if the yields on treasuries are going to go down, why are you guys investing in it? Are you propping up the market? What are you doing? Are you going to buy those treasuries to take some of the load off of foreign investors? What he said today doesn't make any sense. The comment, one last thing, the comment about we don't believe that the interest rate cuts are going to impact the AI boom. I don't know who told him to say that. If you've ever been in the business world ever, you know that your number one thing, if you're building something or taking something to market, like an AI product, like a website, like a house, like a whatever, is cheap money. And cheap money, meaning relatively cheap money. I have a thing called cost of capital, right? All these folks that are building these AI centers have it. What is Amazon's cost of capital? What's Google's cost of capital? What's the cost of capital? How am I going to get my hands on the $50 billion I'm going to need to build a data center the size of Manhattan? If you don't think a quarter point matters in that financing, or if you don't think a half point or a point matters, that's complete nonsense. And here's the thing. Jay knows it. These folks have doctorate degrees and all this stuff. He knows what he said was wrong. So what we saw today was potentially a very hawkish engagement. We saw somebody that said, we might not do anything in December. We might have to wait and see because we don't have the information, the data. I don't believe any of that for a minute. The pressure's on to cut interest rates, and it's coming from the Trump administration. It's clear that the Fed and the administration right now are at odds. The last thing I'm going to say, the big takeaway from this is what? In February, 12 members of the FOMC are up for review. There's going to be massive turnover on that committee, and the folks that are going to stick around are going to be the doves, the ones that want to cut down to 2% and stay there. You'll notice even Powell said it today. He said we're about 1% above the neutral rate. Well, what does that mean? 3.75%. We're looking at what, 2.75%? That's the neutral rate. The Trump administration is going to push hard for a 2% rate. And it's going to look a lot like Japan after the financial crisis in the early 2000s, where you're going to go with cheap money and you're going to try to pump things through the roof. Essentially, that's what we're looking at here. So I would say that we're in for some interesting times. I don't know what the Fed's going to do. Let's see if the powers that be do. Right here, 67%. I mean, this has just been jumping all over. I mean, this has been jumping all over the chart today. They actually took this down when Powell started talking because the futures traders weren't dealing in the interest rates anymore. But take a look at this. All of a sudden, we went from about a 90% chance of a quarter-point rate cut in December down to about a 60-30. And look there's folks that are betting on a rate hike. This is crazy. This was an incredibly hawkish engagement for a quarter-point rate cut. There's no question about it. There's absolutely no question about it. So be very careful. Let me see. SGK, the Trump puppets are about to be installed. Please hold. I think that, no matter what you think of the administration or Trump or whatever you are politically, it is no secret that as a developer and as a builder, Trump wants to get interest rates as low as he possibly can because he knows at the end of the day that's going to grow the markets and it's also going to grow your economy. What it's going to do to inflation, it's going to hurt. There's no way that they can get control of inflation by cutting interest rates. They just can't do it. The idea is that the tariff revenue can sort of offset that. I don't believe it. I think that we're in for. I see one last thing I'm going to say before we sign off. One last point. Number one, our gold trade's getting destroyed. That doesn't surprise me. Wouldn't surprise me if we rally from here, but this is just ugly trading. Very difficult. Bitcoin, pretty much the same thing, although I do like having my back against 110 there. I think that has the potential maybe to rally in the coming hours. This gold trade, I would much rather be holding position longs than shorts, but this is ugly. This is going to get stopped out, it looks like, just because the volatility is what it is today. Dollar yen, I mean, are we going to see the dollar maybe take a step back? I don't know. That was very, very hawkish, and that was a surprise to a lot of people out there. So this crossover strategy, not very good today at all. Remember, if you're going to trade these things around key events, boy, I would be using larger time frames, and I probably would be pumping my brakes on that. As far as what we have over here, this Great Britain Pound USD, I love this level. This is a fantastic zone right around this 131.44, 131.50 zone. That's a long-term monthly support level. We have a trade idea. We'll give you an update on that one on tomorrow's live stream. But this could be pretty good potentially for the coming days. I think that could be a real nice swing trade that just set up for us. So remember, if you want to trade anything, head on over to Switch Markets Community. Get up and running with your free demo account on your MT4 and MT5. You can definitely do that. Last thing I'm going to say is this. I'm going to leave you with this. I'm not a lot of folks out there. You guys have seen all the podcasts and all the YouTubers and everything, and a lot of folks really love to scare people. That's how they try to build a huge audience. I've never been about any of that. I like to answer questions and actually be around traders. That's one of the reasons why I do this, and to sort of pass along some of the beats that I've taken over the years and some of the tips that I have from really being in this thing 15 years now. I don't deal in fear porn. I don't do it. I don't just say, oh, they're all coming for you. The world's going to end. I don't believe it, because if the world's going to end, there's nothing we can really do about it anyways. So you might as well just kick back and enjoy, have a drink and enjoy the ride. What I'm going to say is this. We have the potential for a major market meltdown in Q4 towards this next Fed meeting. Couple of things. Government shutdown doesn't look like it's going to end. Air traffic controllers, I think, they haven't been furloughed, but they officially stopped taking their pay today, or not taking their pay, but being paid today. That's big. That's going to lead to logistical supply side inflation problems. All of a sudden, moving things around isn't going to be as easy as just air travel as usual. So that's number one. Keep an eye on that. Number two, the EBT things expire. The EBT, the SNAP program, the food assistance program, that expires on Saturday, November 1st. Those benefits are not going to go out for November. That has the potential to impact 42 million Americans, and you really have to be very, very careful in a situation like that, because it could spiral into definitely some civil unrest. There's no question about it. If you take logistical challenges and you take civil unrest, you put on top of that some trade tensions, U.S.-China trade tensions, and then you bring in the Fed maybe not cutting interest rates like they're supposed to, but there was a 3% chance they're going to raise interest rates. You bring a surprise move into the equation there. You have all of the fixings for a major correction, a major one. So I'm aware of that. Still, you have to be bullish until proven otherwise. But this dynamic, I mean, what we saw today, I saw it in the live chat a minute. What we saw today was a beaten man. is somebody that is tired of all of it, and he's ready to go to the private sector and doesn't want to do it anymore. I don't care what they say to the press. I don't care what he says. I guarantee behind closed doors, he's like, man, I am done with this. This is a touchy situation. So we're going to see a lot of change in the Fed in the next 6 months. It's going to be a lot of fun. You're going to see a lot of those FOMC members that are going to get, some are going to get promoted, some are going to get put out to pasture. You're going to have a new Fed chair. All of these things point towards really some uncertainty in the market, and I will bet you dollars to donuts that that uncertainty is going to be figured out real quick. It's all going to be dovish. They're going to cut interest rates down to 2%, and they're going to try to create an asset. I'm not just going to say it. It's going to be an asset bubble, and it's going to look great on paper. It's going to look great on paper. Stocks are going to be through the roof. Bitcoin, I mean, I'd be hard-pressed to sell crypto at this juncture. Could happen. But, you're going to see some real changes in the way that equities are valued and risk assets are valued. It's going to be risk on. And I'm very interested to see exactly how this thing pans out. But there's a very real chance of a major pullback by the end of the year. And by that, I mean, a few percent probably, maybe 10%. We could see it. It could happen fast too. But you could also cut a deal in Congress later today. You could get the government open again, and you could get your rate cuts as planned, and the markets just could keep going to the moon. I really don't know what to say about it. All right. SGK, invest in sea shipping companies. Hey, that might be the only way to get things around is in the ocean. That's for sure. All right, guys, I'm going to go ahead and sign off. You have a fantastic trading day. This is sort of this is always one of our longest streams. If you have any questions at all, head on over to How to Trade. I was getting a lot of questions about how do we find the educational content. howtotrade.com. Come on over, sign up for a free account, send me a private message. I will get back to you. If you have any questions at all, be sure to ask. We've got a couple new videos that are going to be dropping here relatively soon. We actually have a new trading journal that we're going to be giving away on Switch Markets. That's going to be on our YouTube channel, so head on over to Switch Markets on YouTube. Check out the video that's going to drop tomorrow, and we also have the link for the free download and everything you need there. And when you watch the video, just leave a comment, say hi. If you have any questions at all, be sure to ask, and we can get you up and running with the trading journal. A lot of you probably already have your journals, but for those of you that are new to the market, a trading journal is absolutely imperative. All right, a shout out to Samir. Absolutely, Samir. I'll give you a shout out. There you go. All right, everybody. Let me see Lander. Everything's above the 200 EMA on the monthly. Can't go long. It's very hard. Very, very hard right now to put my finger on what's going on here. Got a pretty good idea that crude oil is going to come off. We're trading right at 60, though. Probably not going to be till next month. We're going to be looking at this month's lows very closely in crude. I'll cover that more tomorrow. We're back here in about 21 hours, 23 minutes with the Switch Markets live trading webinar. We're going to do some 9 EMA scalping. It's going to be an interesting session, so be sure to come on back and join on the Switch Markets YouTube channel or in the How to Trade trading room. All right, guys, that's a wrap. I'm going to go ahead and get on with it. I believe I got a heavy shoulder day today, so I got to get to the gym and blow off some steam and really go deep and think about what the hell Jay Powell just said. Hey, listen, I have a bachelor's in science in finance, and I remember the economy classes, and I've been studying this for a long time. Some of the banker speak is so abstract, I don't get it. And guess what? We're traders. We don't have to get it. All we got to do is buy low and sell high and vice versa, and I think that puts us in a pretty good position. All right, everybody, I'm going to sign off for right now. Have a fantastic trading day. Trade the action well, and we'll talk soon. See you.